Good afternoon, all, and thank you for joining on today's call on Edelweiss US Technology Fund of Fund. We're absolutely thrilled today to be joined by Joe Wilson, Portfolio Manager of the JP Morgan US Technology Fund, and Supreet Bhan, Head Southeast Asia Funds for JP Morgan Asset Management. I am Shikha Sood from Edelweiss. In today's session, we would be broadly covering two areas. One is the macro picture, which is essentially the interest rate and geopolitical environment. And the second area is going to be around the current state of the US tech sector, followed by the JP Morgan Fund's positioning, and also what's in it for the investors in the coming months. And during this session, you may feel free to post your questions in the comment box or in the Q&A section, and we'll be happy to take them towards the end of the session. Thank you, Joe and Supreet, for joining in. Over to you, Supreet.
Thank you, Shikha, for the opportunity as always, and good afternoon, everybody. And for those of you who are celebrating the auspicious occasion of Buddha Purnima, our best wishes for this auspicious day as well. As Shikha mentioned, we're delighted to have my colleague Joe Wilson on the call. He's the star speaker for today, but I'll try my best to drive the conversation towards the most pertinent points through the course of the conversation. And as Shikha pointed out, the best use of this time after our prepared remarks would be if you can get your pertinent questions. We'll try our best to answer some of those questions as well. So as Shikha pointed out, she set an agenda for us before we dive into the US Technology Fund, which is to speak about macros. And if we jump forward just one slide, let's address the elephant in the room, or should I say the eye in the room, which is the inflation dynamics and interest rate dynamics in the US. So I don't know if you can see slide number 2 on the deck, but if you can, you would probably be able to see the situation with the interest rates or inflation, particularly in the US. On the left-hand side, we're showing you that while inflation's fallen from upwards of 9%, a little over a year and a half back, to close to about 3%, directionally, we are convinced that it is on a decline. It's no longer falling like it fell from 9% to close to 3%. It's falling, if you will, more like a feather. And if you look at the constituents of the inflation, where that's coming from, it's quite evident that a lot of that inflationary forces are coming not from goods inflation. So it's not Americans buying more iPhones or Tesla cars and so on. It's actually on the services side, which is shown on the right-hand side line graphs as well. If you jump forward one slide, that brings us to the main component of why inflation was surprisingly sticky through the period of the last several months. And that has to do with wage inflation. As unemployment remained really tight in the US, the ability for workers to demand higher wages really meant that while goods inflation came down, services sectors, which employed a lot of labor, that witnessed particular upward pressure because of the inflation on wages. And you can again see as inflation's crept up close to about 3.9%, or unemployment has crept up to 3.9%, the wage growth has come down from 7% close to about 4% now. So it's a period of time where while US economy continues to be quite resilient, however, it isn't growing at the 3% or upwards of 3% GDP growth that it saw in 2023. It's close to 2% or slightly lower than 2%, which means unemployment, which was less than close to 3.4% last year, is picking up. And we wouldn't be surprised if it's closer to 4% by the end of the year as well, really taking away some of those bargaining power from the laborers to demand higher wages as well. If you go to the next slide, it also begs a question on what's happening and why was the inflation print, particularly in the months of March and February, surprisingly strong? And it has to do with some of the financial conditions in the US. So if you notice on the right-hand side, whenever you see tight financial conditions, which is that gray line tends upwards, it usually sets the stage for inflation to cool down. And as that line comes down, usually sets up a stage for some surprises, particularly higher than expected inflation numbers, which is exactly what happened earlier in this year. And as we noticed, since April in particularly was a tough month for markets, financial conditions were tighter. Therefore, the latest inflation print that's come has been in line or slightly better than expected by the markets as well. So that's the other thing that you need to watch in addition to wage pressures. You need to watch out for financial conditions, which is why there is a slight paradox that the Fed is dealing with, which is for them to cut interest rates, they must convince the markets that they're not going to cut interest rates. So it's quite possible that over the next few months, you might see the Fed being unusually hawkish, or at least being less dovish than what the market expects them to, because as I pointed out, financial conditions, which can lead to some surprises on the upside and disappoint the efforts of the Federal Reserve towards their campaign to take inflation closer to their target levels. They might sound less dovish or slightly more hawkish as well. However, despite these conditions, we do expect to see a rate cut on the horizon. The distance to that horizon is clearly uncertain. So whether it's this year, whether it's the last quarter of this calendar year, that really is the uncertain part. But we are convinced that the next action by the Federal Reserve is likely to be a rate cut. Definitely, in our opinion, given the conditions right now, it's not likely to be a rate hike, which takes us to the next slide, which is really a representation of the interest rates, particularly on the right-hand side, as you see. And I want you to cast your eyes on the gray dotted line, which is giving you the FOMC's own year-end estimates, which does show you a more dovish environment that they expect over a period of time. Now, the market expectation obviously moves a lot more than Fed's own comments. So the market expectations are given in the green dotted lines. And the gray shaded portion that you see around there is the range in which the market expectations have moved. So, there was a period of time that the market was a lot more optimistic, start of the year, expecting 6 rate cuts, to a point where just about a month back, they started assigning a 20% probability to the next action, possibly being a rate hike, to now expecting a slower rate cut path than even the Federal Reserve. But if I had to bring all of this together, U.S. economy is still fairly resilient. No longer is the market worried about a hard landing. It's really about what is the pace of growth, and if the great pace of growth allows the inflation to come down to levels that permits or gives latitude to the Federal Reserve to cut rates. And as I mentioned, we do see it on the horizon, just the timing is uncertain. I did want to cover that, but at the same time, I'd be remiss if I didn't point out that the strategy in particular that we're discussing today, which is US Technology Fund, I'd ask you to focus on fundamentals. I know that most of us many a times get particularly preoccupied by what's happening in macros. They are important, but over the longer term, the primary driver of stock prices tends to be the earnings growth. And to that point, I'm delighted to be joined by my colleague, Joe Wilson, who's the lead portfolio manager for the US Technology Fund. Just before I hand over the strategy to him, I must point out that we launched this strategy through the feeder fund with Edelweiss somewhere around March 2020. And in a little over 4 years' time, and I myself being an investor in the feeder fund in India, I noticed, and I did that calculation last night when I was preparing for this call, I noticed that since inception of the feeder fund returns, which is since March 2020, till now, the annualized return of the strategy is close to about 23.5%, which is a fairly strong performance. And do note that the strategy has gone through COVID, because we launched it right at the start of what was turning out to be a significant event in our generation. It went through COVID. It went through the significant change in the interest rate order from 0% to upwards of 5%. Sort of whipsaw between whether the Fed's cutting or whether the Fed's going to hold higher for longer, and so on and so forth. So again, going back to the point that I made, which is as we go through this conversation, I'd urge you to focus more on specific of the sector, the technology companies, and the opportunities that some of these long-term structural trends present to investors, while we focused a little bit in the beginning on macros, and we'd be happy to take some of the questions towards the Q&A section as well. At this point, let me invite Joe in. Joe, walk us through, and you've been managing this portfolio for several years now. Please walk us through, what do you look for when you're building a portfolio such as the US Technology Fund?
Thanks so much, Supreet, and thanks Shikha as well too, for the opportunity to speak with you and your clients as well. And the opportunity, I think you hit on, well, I'm not an economist. My best skills are related to identifying disruptive technologies and disruptive trends and changing trends within technology. What I think is something really important to appreciate in this much larger discussion around the macro is that for 100 years, technology has been the key enabler to beat down inflation. It is the key enabler to efficiencies. And something to think of at this point in time, where we're not sure where inflation will level out longer term, is that every single business in the world is looking now more than ever, especially at the dawn of a new era driven by AI, for technology to help drive cost discipline, efficiency, and growth within their companies. Earlier this week, JP Morgan held their annual tech conference in Boston. And at that conference, the discussion focused on JP Morgan's tech budget, so our own internal budget, moving from $14.5 billion last year to over $17 billion this year. In my 20 years working for financial institutions, in my 10 years working at JP Morgan, I've never seen an increase of this magnitude. And I think that highlights this importance of technology enabling not just technology for tech, but tech more broadly across the economy. And Supreet, I know you talked about performance since the beginning of 2020, which I think is, highlights importantly how we've trended through a very volatile period of different rate environments. And I'm very proud of that performance, but I'm also very proud of the performance that we've had over our 5-year, our 10-year period as well too, the longer term performance, and even last year and year to date, which highlights not only are we doing well against our benchmark, we're doing very well against passive strategies like the Qs or XLK, for example. And the key highlight there is that, well, those strategies and passive strategies are really huddled into just a very few names, like the Mag 7, for example, where the majority of the performance comes from. Our outperformance is coming from the companies that aren't the Mag 7 necessarily, right? We own 62 companies in our portfolio, and we own some of the Mag 7, but not in the size that drives the substantial performance that we've had. It comes from companies that we identify and benefit from these changing tech landscape. We've always invested, on the slide 6, we talk about leadership, the evolution of leadership. And that's investing with this humility that the companies that lead today might not be the companies that lead tomorrow. And now more than ever, we've seen this happen from one generation, whether it was mainframe to PC or PC to internet, and internet to mobile cloud. We're now at the dawn of a new era, and I think this is even more important for investors to acknowledge, is that those companies today that have led the last decade or the last 2 decades are ripe for disruption. We have made a lot of money for our clients by identifying those companies that are challengers in respective categories. I think of companies like Tesla challenging a much larger legacy auto economy. I think about companies like The Trade Desk, who have focused digital advertising not just across the web, but specifically for connected TV. In an age when Netflix is emerging as an industry leader in streaming, and our habits and the way that we consume media changes, Trade Desk is now more important than ever. And yes, Google has done well, but Trade Desk has gone up 10x more than what Google and Alphabet has gone up. And so really having that belief in leadership evolution drives us to identify that next change. I think it's also really important to highlight that the pace of which technology is adopted is constant, and it's constantly growing. A lot of times investors like to think one of two extremes. We're in a bubble or technology is dead, right? And in 2020, at the end of 2020, when we were hitting all-time highs and valuations look crazy, it was the view that technology is in a bubble. And then at the end of 2022, when names had come in 50%, 60%, and tech pulled back in an extreme way, there was a view that technology is dead. But think about our own personal lives. Our consumption of technology didn't change. And in fact, when we saw ChatGPT in September of 2022, the whole world changed. The whole world started to acknowledge that technology is maybe going to accelerate in our lives. Thinking through like the advent of and potential for AI assistance. And that is where we're in this new reality that the adoption of tech is only going to increase. The last thing that I think is really important for our investors is to understand that tech is broadening out. Technology will disrupt every single market of the economy, whether it's financial institutions, auto, industrial, manufacturing, healthcare, whether it's on the services side or it's on drug discovery. Consumer for sure, that's the most obvious. But every single industry, even energy, is going to be impacted by technology. What we can do with our fund is we're allowed to go outside of just what is classified by the S&P or classified by Bloomberg as technology. We're able to go and seek out those other companies that are going to change the landscape within other sectors. And what better person to be able to say what is going to be a winner or loser than a tech analyst who understands the economics of layering in software, of growing at massive scale. And that's how we drove a huge amount of alpha from companies like Tesla or companies like Dexcom or First Solar. The other critical thing to remember as well too is on the slide that we're on now is that flexibility to invest across different market caps, right? At a point in time where everybody is, constantly putting together 5 names or 7 names that have leading market cap, whether it's the Mag 7 or the AI 5, is to appreciate that disruption doesn't extend to just one company or a handful of companies. In fact, maybe the most alpha that we're going to generate is going to come from small cap or mid cap companies that are much more underappreciated, less loved, and less discovered. And that's where we can also generate a lot of alpha, right? When we can identify a disruptive small or mid cap company where we think fundamentals are here and expectations are only right here. And not a lot of people appreciate this now, but NVIDIA used to be one of those companies. When we first invested in NVIDIA, it was in February of 2016, before anybody was talking about AI. And NVIDIA was just a 20 billion market cap company. Look at it today, it's 2 trillion. We've gone up, we've made 100x on that investment. Those are the types of returns that we look to populate in the portfolio to drive significant alpha and performance for our clients.
Those are very useful opening comments. And maybe at this point, if I just bring in the performance of the strategy, just to set the context and level set, while the US JP Morgan US Technology Fund has been in existence for a fairly long period of time. As I mentioned, the strategy in India has been about 4 years, but for your benefit, we've shown the long-term performance here, which is on the top half of the slide, whether it's the 10-year performance, 5-year performance, near-term performance, whether it's 1 year, 3 years, the fund has consistently outperformed its benchmark, and its benchmark being the Russell 1000 Technology Index, which to us represents the technology opportunity a lot better. As Joe pointed out, it's not just a large cap, it's also the broader segment of technology and technology-enabled businesses as well. For your benefit, we've given you calendar year returns in the bottom half as well. And again, I must point out this strategy is a high-growth technology strategy. So, it will characteristically be volatile. Therefore, for those of you who are on the call who are evaluating this for your portfolios, please do recognize the volatility characteristics of this portfolio and accordingly have an allocation to this specific sector and this strategy as well. But Joe, just staying with years like 2023, as you pointed out, 22, the mood was just the opposite of the mood now. 2022-23 was particularly a strong year, and year to date as well, the strategy's done fairly well. I know this data is as of end of April. I can tell you that the latest numbers is that year to date, the strategy is up almost 12%. Walk us through, in your view, what have been the reasons for this outperformance, both relative to the benchmark and then also in absolute terms as well?
Yeah, well, I think 2020 was an extreme change in the way that we were working from home, consuming services, shopping, commerce, collaboration, and it was all driven by technology. So put an exclamation point on all the names that we were positioned well for at the end of 2019, and that generated an extreme amount of returns. And what happened in 2021 and 2021 was much more volatile. Still end of the year, pretty solid. But 2022 was a year of digestion, right? And I think this was actually a very healthy move for technology, because what we had seen, not just in the 2 years that preceded that, but I think in the 2 decades that preceded that, was a lot of complacency within Silicon Valley and what the status quo was for a U.S. tech company. And that was that we hire aggressively to match our revenue growth. And that was especially true in 2020 and 2021. But what wasn't realized was that was some of the easiest selling that ever had to be done. In fact, it didn't really even require selling. Everything was just being purchased, right? It wasn't pushed, it was pulled. And 2022, when we had this digestion phase of enterprises rationalizing how much they had just spent, right? Maybe we bought too many Zoom licenses as we come back to work, and we actually aren't going to a new normal of everybody working from home. We're going back to the old normal, the normal. And so there was a lot of digestions of key technology spend that had occurred. It made growth much more difficult because you just had more difficult comparisons as well. But what happened as stocks came in was that executives and CEOs who pay their employees with stock and pay themselves with stock started to appreciate that maybe something has to change. And we saw that first start with Elon Musk when he acquires Twitter and then eliminates 50% of the positions, right? Not only did Twitter, or what is now called X, not go down, it actually got better. Product innovation accelerated. And the efficiencies that company created have been long-lasting efficiencies. And I think it would be a very smart, it would be very intelligent to assume that Mark Zuckerberg and Meta were taking notice of what happened at Twitter. And that's why Meta, a month or two after Twitter eliminates half the headcount, reduced their headcount by 30%. And then we just started to see the dominoes fall. Any high growth company that was neutral or free cash flow negative started to take headcount down. That changed the culture of the Valley, one of growth at any cost to profitable growth. I think that's actually what sets up technology to be one of the strongest sectors for the next 10 years, is that we now have a more focus on product and efficiency inside of tech. It could be have some of the strongest earnings growth that we're going to see. And I think that observation, along with after having this digestion period, drove 2023 results. And then you also had AI investment and what the hyperscalers are spending, and semiconductor and semi-cap equipment companies being much more well appreciated for the leadership that they have. We've been fortunate to have a pretty large overweight to semis and semi-cap equipment within the portfolio, and that has benefited us in a tremendous way, in a way that's allowed us to outperform our benchmark and the Qs.
If in that context, if you just go forward to one slide, I do want to reference some of the metrics of this strategy. I think if you look at the table on the top left-hand side, I'll bring your focus to the second row from the top. price earnings multiple, as Joe pointed out, from a period of growth at any cost to growth with profitable growth at reasonable price. 27.2. It's not a demanding valuation for a sector that's growing, and particularly when you look at the EPS growth, which is the row just on the bottom, just below the PE multiple as well. So sure, we're paying a higher multiple relative to the benchmark, but that is at the outcome of almost twice the earnings growth compared to the benchmark as well. And therefore, I pointed out that this is a high growth technology fund, and characteristically, we'd look to buy companies which are growing faster than the broader market, and we're willing to pay a premium for that as well. Quick look at the next slide, which shows some of the top performers for the strategy in 2020 in the last 1 year. So some of those large cap names do pop up, unsurprisingly, whether it's Nvidia, Meta, and some Uber, and as well as Amazon. If you go to the next slide, that's just the outcome that we've seen, or leadership that we've seen from some of these companies year till date as well. I'm wondering, do you have any comments on these two periods, Joe, particularly around year till date in 2024, if you've seen any significant shifts in this period of time?
No, I think what is really interesting is this discussion. I get a lot of feedback from clients in meetings about, valuations being extended. And I think, Nvidia is a great example of a company that looked expensive if you're looking on trailing numbers, looks expensive if you look at a stock chart and maybe you feel like, oh, I missed it. The reality is that, while we thought Nvidia actually was attractively priced and still had a lot of upside left, what happened after they reported earnings just last night or this morning was that it was actually cheaper than what everybody thought. Forward numbers actually went up by will be going up by over 20%, and that is, I think, the key focus here for the next few minutes of discussion when we dive a little bit deeper into AI. But it's not just Nvidia. There's many other companies that this year on the infrastructure side for sure are going to benefit, but over the next 3, 5, and 10 years, as we move forward, there's going to be massive profit pools that are unlocked for companies that are leading with a technology-focused or a tech-enabled product strategy.
So my news feed over the last week, and let me point out last week when OpenAI launched GPT-4 Omni, that was the number one thing I woke up to one morning last week. And this morning, obviously, as you pointed out, NVIDIA's blockbuster results as well. And by the way, I'm not a tech geek at all. If anything, I'm the opposite of a tech nerd, and still my feed just pops up every time with some of these technology developments as well. It reminds me, Joe, of the time that I was studying my engineering back in the mid-90s, and that's probably going to give away my age. But at that time, internet as a technology was coming up, and if you're a millennial or a Gen Z on the call, you probably not understand what I mean when I say a dial-up connection, which sounded like somebody's clearing their throat. And if my mom picked up the phone to speak to somebody, that was it. The connection was gone. From at that time, in the 90s, while I was studying my engineering, if somebody would have told me that internet as a technology is going to change the world as we know it, it's going to change the way we work, the way we live, and the way we socialize, I couldn't have gathered the impact that it would have. And also the big names of that time in the 90s, and obviously that technology frenzy around .com led to a .com boom followed by a bust. They were leaders at that time, similar to the ones that we know of today. But those names, many of you may not be familiar with. So while Microsoft is one of the common names that comes from that time and even today, there were names such as Sun Microsystems, which is an expert in Unix and Java at that time. Most of you may not have heard of it as well. Then there was, of course, Oracle, which was a fast-moving company. And that time, companies that were providing the infrastructure for this technology were also doing particularly well and were the darlings of the market, something like Cisco. Some companies that have become household names today because of that technology didn't even exist. So names such as Google. Apple was a manufacturer of these clunky Mac machines that not a lot of people wanted. And Amazon used to still sell books at the time. as you know, over the next decade or so, that the shape of the industry changed a lot. There were businesses that took that technology and used the application of it and weren't necessarily the ones that the markets thought in the 90s would be the beneficiary of that technology. Joe, my question to you is, everything today and there's a fair amount of hype and discussion around AI. While there's tremendous opportunity, how do you approach that opportunity when you look at winners in the future, and what could be perhaps some of the beneficiaries of this, what seems like a significant shift in technology and the shape of the technology in the future?
That's a great intro to this slide, Supreet, and I think it highlights. Now that I know your age, I know that you would be able to recognize.
I just started early. That's all.
Every company in 1980, but a 20-year-old is not going to know, any more than three of these names. But we have to, having this understanding on history is extremely important. And I've done I was only 5 years old in 1985. But I've gone back and read many articles and research written about IBM in 1985. And so I've done my historical studies on tech from that point in time. And what's interesting is to come across articles in 1985 in the Times newspaper, for example, calling for a breakup and regulatory actions on IBM because they had an unfair competitive advantage. And if you would ask anybody in 1985 who is going to lead technology for the next 50 years, undoubtedly, with 100% certainty, IBM. But what happened, right? I think companies that have this leadership, one of two things happen. Either they lose their market, so they make a product misstep, or their market becomes irrelevant. And in the case of IBM, even today, they still kick butt, do very well in mainframe compute. But every platform that came after that they did not capture, had profit pools that were magnitudes larger, right? And that is why IBM is no longer on the list. And it's why companies like Apple, who identified mobile driven off of internet, took extreme leadership. The reason why, I think this chart makes Microsoft look a little bit better than reality, but Microsoft missed mobile and cloud. They caught up because of Satya. And if it wasn't for him, I don't know where the company would be today. But because of him and because of that innovation and change, they've been able to keep their relevance. But many companies from 2000 are nowhere near the leadership. In fact, if we were to build this list today on 2024, a company that has never appeared on any of these eras, NVIDIA, would be in the number 3 slot. That's incredible to think as how quickly this disruption can occur. And it's now more important than it ever has before because we are at the dawn of a new era. And we didn't cherry pick this slide and put AI up after we saw ChatGPT. We've been using this slide for 6-7 years because of all the foundational work that we did on NVIDIA between 2015 and 2016. I am confident that in 2030, half the companies from 2020 are likely to be off the list. One of those happens to be one of the most well-respected companies, Apple. And it's a company that we don't own in the portfolio today. And I think this helps to, explain why we need to break these companies up out of this monolith, Mag 7 or Fab 5, is because they're all operating in different sequences. And Apple seems to have really lost innovation, right? The major pitch for Apple today is titanium shell on the handset. And guess what? That is not spurring an upgrade cycle. They've underinvested in compute. They've outsourced it. So they don't have the GPUs to train a large language model. They are going to empower the next leader on this chart, potentially, OpenAI, when they partner with them and start distributing in OpenAI to make Siri better. These are the things that we have to think of when we invest, is have that humility to understand that the companies that are leaders today, unless they operate with 100% perfection, are at risk of not achieving leadership in the next era. When we go to the next slide, the reason that we're so excited about this dawn of a new era is because it drives a brand new compute cycle. Jensen said this morning that we've spent $1 trillion on x86 compute, and all of it is basically garbage when we start to think about how we are going to build applications in the future that are all AI supported, right? And it's the reason why, just like if you look at that 2024 number of $163 billion that's only being spent by 5 hyperscale companies, it's actually closer to $180 billion now after this last earnings that we went through. But that alone is up 10x in the last 10 years. We think we're going to accelerate from here over the next 10. The next 5 years are going to be about making us all more efficient, right? This mentality of driving efficiencies in the workforce, making us more powerful. When Jensen, the CEO of NVIDIA, was in our office a few months ago, he said, AI isn't going to take your job, but the person using AI is going to take your job. Microsoft brands a Copilot. It makes it sound very friendly. It's my buddy. It's going to help me, go through my email, create documents, create PowerPoints much more efficiently than I ever have been able to do before. But I think within 3 to 5 years, we're going to enter a period where we go from Copilot to what I call Pilot. And we will see some replacement of labor. That is when CapEx is going to accelerate, because there's a much more clear and identifiable ROI of using software or AI software married with AI hardware. Maybe it's a robot for manufacturing. That spend is going to accelerate. And then if we go to the next slide, many people think that this new economy is only going to accrue to the biggest companies in the world, the companies that are spending the CapEx. And well, I think they have a pretty strong benefit, whether that's Google spending to build out GCP, or Amazon to build out AWS, or Microsoft to support Azure. I think they'll continue to do well on cloud services and renting out GPUs. But the companies that are going to accrue the greatest benefit are the ones that are solving the bottleneck for all of that CapEx spend and data center complexity. Building a semiconductor is becoming much more challenging. Putting that together in a rack is becoming much more difficult. And then putting that into a data center, it becomes obvious that there's bottlenecks in networking, in power, and in memory. And Google or Meta and Amazon, they're not solving it. Jensen can only do so much, so NVIDIA is not solving all these problems. But there's companies that have 10 and 20 years of R&D experience that solve each one of these. So in networking, we own companies like Credo, which is a $3 billion market cap company. We own Marvell. We own Arista. We own Broadcom, which sells the leading networking chip for white labels, but also to Arista. In power, we own companies like Vicor and Monolithic Power. But we could also put Supermicro on that list, who's solving for direct-to-chip cooling. In memory, it's Rambus, it's Micron. And then there's this other brand new category, custom processors, a category that didn't exist 6 or 7 years ago. But this is all the hyperscalers that are trying to build their own chip that alleviates the requirement of I have to pay the NVIDIA tax forever. And this is them trying to develop their own silicon using Synopsys software, using Broadcom or Marvell to lend IP and to help design, and then taking it to TSM, which is another holding in our portfolio. These companies are much more underappreciated for that, the chart I showed on the previous slide, of that major CapEx cycle. And that is the benefit of the tech strategy that we manage, is understanding the importance, the IP that is controlled in these companies, and how they're partnering with NVIDIA or with the hyperscalers to create solutions to these bottlenecks. And guess what? They're going to take a premium for these solutions, because the end market, which is the services that ChatGPT and OpenAI is selling, or Microsoft is selling, or the incorporation of AI by Meta into all of its marketing verticals for targeting and building ad creations, are creating even greater profit pools that will support a more level playing field for profit sharing across semis and business services.
This reminds me of an analogy that I've used very often, which is, in a gold rush, don't just focus on the gold mining companies, but indeed think about those companies that sell picks and shovels to those gold mining companies. And I think some of the examples that you've outlined here serve that analogy quite appropriately as well. Can I use the next few minutes, Joe, just to stretch you and get your comments on what do you think could be the direction of application of AI in your mind over the next decade or so. And I ask because, yes, ChatGPT is unique, it's revolutionary, but is it going to change the world? I'm not particularly convinced about that yet. But do you think artificial intelligence could potentially, or application of artificial intelligence could be life-changing in the form of medical diagnostics, where it could assist, like you said, Copilot in Microsoft? Could it be a Copilot or a pilot for doctors to diagnose critical illnesses? Many other problems that humans are just not able to solve. And I know I'm getting into the realm of something very long-term, but if quantum computing, which does away with bits and, binary 0 1s and goes into qubits and all that era, what do you think could potentially be the life-changing, world-changing applications that perhaps one should think about over the long term?
That's a great question, and I have a high amount of confidence that AI will reshape and change the way that we interact, socialize, and operate on a daily basis. And you asked about healthcare, for example. Google is already using AI and has been for the last few years through their Verily company to identify diabetic retinopathy, which is the leading preventable cause of blindness around the world. And in mature societies, we have doctors that are able to diagnose that. There's many economies around the world where there's no availability of a doctor. And being able to use a handset and a camera to be able to take a picture of your eye, upload it, and be diagnosed is pretty powerful. That's just one example, but already within radiology, AI has proven that it can be as good or better than a radiologist. And it still feels like we're day one on AI. So that's a service that's only going to improve. We've been on the call recently in the last 6 months with the CTO for Regeneron and Lilly. They're starting to use Gen AI to discover small molecules that are more accurate at targeting specific diseases. That's something that was never done before. So just think of time to market or even customized medicine. Intuitive Surgical, we're still waiting to see their next generation robot, but it's becoming, it's supposedly in the next few years, will have the ability to have much more broad application for surgeries. Those are the things that it's unlocking in healthcare already. And then when I think about the profound change that it's going to have, OpenAI last week gave us a glimpse of why every single person today, and remember, everybody on the planet, for the most part, is already now connected to the web through a handset, but why every single person will have and rely on assistance. And it's because it's not just a compute that is really good at taking instruction sets and doing work for you, but it's also becoming something that is very human-like in its ability to converse, but also to have emotions, right? I was more shocked at two things from OpenAI. One was the latency, which allows you to have a really quick conversation with AI without having these long pauses. So that's interesting. But then the other one was the emotion, whether it was sarcasm, laughter, happiness, sadness from an AI. That's the magic trick that we're all going to be shocked at as we start to use it in our daily lives. And the last thing I think that we have to appreciate, I've been using these sunglasses from Meta for the last few months. And in them, it has they look like regular sunglasses. They're actually made by Luxottica Ray-Ban, but they has Meta technology inside. And it also accesses a large language model, Llama 3 multimodal. So it has two cameras, one for taking still pictures, one for taking videos. And so you can ask it to take a picture, you can ask it to take a video, you can ask it what the weather's going to be. But now you can also say, look and tell me what type of shoes those are and where you think I could buy those at. Look and tell me what building that is and tell me the history of it. Give me directions to, the Starbucks down this, in a new town that you're visiting. That's giving us like this early glimpse of like how powerful AI is going to be. And Google the next day after OpenAI had their spring release showed us what persistent AI is going to be, where we no longer have to tell it to look and tell us. You just say, hey, what building is that? When you're in the car the next day and it says, remember that your wife said you have to pick your son up at 2:00 and you're 20 minutes away, you better get going. Like there will be a point in time 3, 4, 5 years from now where if our AI wasn't inferencing every conversation we have and the interactions we have, we're going to be upset. And I know that sounds, intrusive maybe today, but it's that slow adoption that all of a sudden is just there. It's kind of like 20 years ago, if you would have told somebody, everybody on the planet is going to be taking pictures of themselves and uploading it for the world to see. No, everybody like, oh, that's a dumb idea. Who would do that? But now kids are doing that and adults are doing that 1 billion times a day. Selfies and Instagram and TikTok. And it's these behaviors that just kind of sneak up and then all of a sudden everybody has adopted it. And I feel like that is the impact that AI is going to have on our personalized and consumer lives.
That's really important. The extent of possibilities is quite staggering as well. Tie that into the portfolio, Joe, for the final segment of our prepared remarks, and we'll open it up for Q&A from the audience. How do you use these possibilities where technology can be used by other industries, as you pointed out? And we had a conversation around medical industry taking AI potentially in the future and several other industries, in identifying those lesser known names today, or perhaps those names which haven't even made the list right now, but potentially could make your portfolio in the future in the context of what are clearly household names like the Magnificent Seven or the top 10 companies which dominate the market and certainly dominate the news today as well?
Yeah, what we're really good at on our team is we have these common characteristics that we all share, and we're very curious. So we all are, tech gadget obsessed, technology obsessed, and things strike our curiosity, whether that's, how is Alexa capable of understanding, this was 8 years ago for me, but the reason that we found our way into NVIDIA was I was impressed by Alexa's ability to understand my 3-year-old at the time, and comparing that relative to Siri not able to answer anything I asked it, for the 5 years before that. And I learned that, what Amazon was doing was something completely different on natural language processing. So we're very curious, but we also have to be creative in terms of thinking of like how this can reshape a landscape in the future and what leadership could look like. Sometimes that requires us thinking backwards. If this company has grown from 200 million in revenue to 1 billion, what went right for it? So we have to be creative in our thinking as well too, and also not put a ceiling on what the possibilities are. That is especially true with NVIDIA. And then lastly, there's an extreme amount of collaboration. While I sit with a team of 3 other tech analysts that support our strategy, I also sit next to an industrials analyst who I've worked very closely on Tesla with, because something struck my eye with Tesla, which is the fact that computers were now able to see and hear for the first time ever, and most likely had a capability to reason. And I thought, well, if you could sell that, what does that do for the margins of a Tesla? And that was something I collaborated closely with Rob Maloney, an industrial analyst within JP Morgan on healthcare, working closely with Holly, who covers healthcare devices, and thinking, how does Dexcom, which to me looked very much like a data company, continue to take leadership for diabetic care? And what does that look like if they're able to not just help on glucose monitoring, but also maybe start to identify the interaction that humans have with foods and the reaction that has on their body, using something that is a little bit more intrusive than just what Apple is doing with an Apple Watch or Google does with their watch. And so it's thinking about all these different categories and how adoption and trends change over time. I mentioned two companies. We don't own Dexcom in the portfolio today, but Tesla is still a large position. We own companies like First Solar, which is the leading provider and developer of solar panels in the U.S. And we've recognized all of the power challenges that are faced by utilities around the United States, and it isn't just about not having enough power capability coming from coal or natural gas. It's about the distribution of power. And the fact is that building a solar field in an area that might support a data center in a cooler climate much easier is going to be much more cost effective and cut a lot of, instead of deploying natural resources backed energy to support the power for that data center. So that's why First Solar is a big position in our strategy. So we have to just think differently and think through all the impacts that technology is able to affect across many, many different industries. And we're fortunate not just to sit across a team that has all these different specialties, but also to sit within a large bank that's well respected and has lots of relationships with private companies, public companies, well-respected experts in their field, and those are the conversations that inspire us, to dig deeper into many of the names that are in the fund.
If we tie that into the stats of the fund, if you can go to the next slide, Shikha, I think it speaks to the edge that JP Morgan's active investment capabilities brings, which is, you can see clearly here that we've compared both the mega cap exposure in our portfolio to that of some of the popular benchmarks, whether it's the S&P 500 or the NASDAQ 100 index. And we've also compared in light green the earnings growth of these different portfolios. So what stands out is exactly what Joe's been speaking about. Despite our relatively low position in those mega caps, close to about 14-15% compared to 1/3 of the portfolio in NASDAQ 100 being dominated by these mega cap names, we are able to generate a significantly higher earnings growth, which, if you go back to my opening comments, is the primary driver of stock prices over the long term as well. We go to the next slide that gives you a quick representation of the top 10 holdings of the portfolio as of end of April. So some large names out of those 14% which belong in the mega cap, but you do also see some names which are out of those names as well. And Joe did allude to names such as Synopsys and some of the others as well. It's been a riveting conversation, Joe. I feel like 1 hour is not long enough to have this conversation. I know you're on a roadshow around Asia, and I certainly hope that on one of your next trips, we are able to take you across to India and certainly across Mumbai as well.
That would be awesome.
Let me just,
I love it.
Yeah, no, we look forward to that, and we'll set that up with Edelweiss, and hopefully that could be for the 5th year anniversary of the fund, and also to celebrate $500 million in assets in India as well. Let me just try and summarize what we discussed so far, and I'll pass it over to Shikha for some questions. What we've discussed is that we are at the dawn of a new era in technology, which is defined by AI, multiple possibilities and opportunities that are likely to happen over the next 5 to 10 years. We've discussed, and hopefully that's come across to you, that be active in these markets, not just focus on the large caps and today's leaders, but to be really positioned to benefit from the current wave of innovation that are going to create future winners and leaders that are going to emerge. And hopefully, through the performance of the strategy over the long term, as well as the conversation that I've had with Joe today, we've been able to establish that JP Morgan US Technology Fund indeed delivers that edge by adding value, by identifying those technology and technology-enabled winners across the market cap space and across several industries as well. With that, let me pass it over to Shikha for your questions. Shikha, over to you.
Thank you, Joe, and thanks, Supreet, for the insights. I just request the participants to post any questions that they may have in the comment box or in the Q&A section. So until then, Joe, Supreet, I think a good time to probably link the two portions. So we've spoken of macro, of interest rates, we've spoken of our portfolio. But if we could link the two and guide investors on where can they expect the US tech sector to move in the next couple of months?
Yeah. Look, I can't tell you where interest rates are going to be 2 months from now or a year from now or 2 years from now. What I can tell you is that technology has done, and our strategy has done very well in two very different environments, one of lower for longer and one of higher for longer. Where we didn't do as well and where tech was hurt was when we had the volatility of rates moving up very quickly. I don't think that environment is likely over the next year or two. And what our benefit is that technology has shown to do very well in stable environments. And of course, we all know what happens when rates also start to go down. Growth and tech do very well. And I feel like that's the rate environment that we're going into. It hasn't happened yet. And we've still done very well across our small cap and mid cap names because we are very bottom up. We're picking good companies that have cash flow or have the opportunity to have substantial margins in the future. And I think that is what will drive and sustain this portfolio over the next year, 2 years, and 10 years.
Sure. Thanks, Joe. Another question now, I'm just looking at some of the questions that we have received. So we can see that we have the lowest exposure to mega cap companies. However, when we look at the market capitalization that is greater than $50 billion, there we can see that gradually that portion allocation to those stocks has been increasing. So can you give a little more sense? And also if I may connect this to another aspect, which is while we've spoken that there are opportunities beyond the Magnificent Seven, and we've spoken in detail on NVIDIA, Apple, and also some parts on Tesla, can you just share a little more insights on the stocks from the Mag 7, which we are not overweight on?
Sure. So Apple is the outlier that we do not own in the portfolio. And that is because the opportunities for other assets that we own in the portfolio presented much greater upside opportunity and a much more favorable risk reward. I worry about Apple. I think I highlighted, the fact that they don't spend a lot on CapEx. Their market share and the market for handsets is pretty flat. In fact, Apple's units have been declining every year for the last 4 years. And we're at a point in time where AI is going to change the landscape and they've underinvested. And we're also at a point in time where the US government doesn't really like the $20 billion payment that Alphabet gives Apple to be default on search. And if that goes away, there's much larger problems for Apple than there is for Google. So, I think that highlights, the weights there. I think what's important to contrast that with is Meta, which is one of our top holdings. And the reason why we own Meta is because they have embraced AI earlier than anybody else is. People are looking for hey, when is AI going to start to generate revenue? Look no further than Meta. All of their ad product is based on AI, right? They lost all of their ability to understand which ads to show us 2 years ago when Apple removed their ability to trace our web browsing history. So Meta had to rebuild their ability to identify what we are likely to click on. They did that all with AI infrastructure. Not only are they able to identify who to show what ad, they're also using their AI infrastructure to create an ad. And guess what? So close to 70% of their revenue of advertising and marketing budgets comes from small and mid-sized businesses. And if you know anybody that's a small and mid-sized owner, you might know that majority of them are terrible at marketing and creative, and they pay other companies lots of money to build those ads. Guess what? Now all you have to do is go into Meta, link to your website, tell them what type of business you are, and say, I want to spend $1,000 a month with you to identify new customers for my service. And Meta will build you the advertisement that they're going to show on Instagram or Meta on WhatsApp, and they'll choose which one is the best location to display it at. And guess what? They won't build you just one ad. They will build you 1,000 different ads. They'll build one that's specific to you or specific to me that's going to make me more likely to click on it at a time when I'm more likely to need that service. That is an extreme amount of capability and power that's all built on AI infrastructure. I think I missed your first question though as well too. What was that one?
So Joe, we've noticed that the mega cap exposure in the JP Morgan fund is relatively lower versus the other, or rather Max 7 exposure is relatively lower versus the other indices that we saw. However, when we see the market capitalization exposure that is greater than 50 billion, we can see that is slightly increased over the last couple of months. So what can that be essentially attributed to?
Yeah, so a big part of that is Meta. A big part of that is NVIDIA as well too. And then also adding back to our position in Tesla, adding a pretty significant amount back into Oracle as well too. I think what's important to understand here is I don't manage the portfolio to look different than the Qs or look different than K. I don't manage the portfolio to have more small cap or more mid cap. We're bottom up investors, so we're looking for companies that have an ability to surprise people, right? We're looking for companies where we think fundamentals are here and everybody else thinks expectations are here. And as we're right, the stock price rises, and expectations will then fill into our fundamental view. That's how we make money in the stock market. That can happen with a mega cap company. It can also happen with a small cap company and a mid cap company. So our overweights in NVIDIA and Meta highlight the fact that we still think there's a huge opportunity with two of the largest companies in the world. We have a pretty decent weight in Google. We own 3%. We own around 3.5% in Amazon. We think that those have a great amount of upside as well too, and a favorable risk reward. Once expectations meet fundamentals, that's when we start to take our position size down. And guess what we bring up? Those companies that have a more favorable risk reward, a greater magnitude of upside, and also the ones where we have really confidence that they have leadership in their product, technology, management, and we have a good market outlook for the industry that they compete in.
Just add a couple of comments to it, Shikha. So compared to a more concentrated index like a NASDAQ 100, which a lot of Indian investors are very familiar with, for instance, to Joe's point that the risk reward has been favorable, but you also reward on an absolute basis has been favorable as well. So over the last 10 years, this strategy has outperformed the NASDAQ 100 by 3% annualized in that period of time. And over the last 1 year, which is clearly a very short term, it's outperformed NASDAQ by about 20%, which really speaks to the active management and merits of finding opportunities beyond just the large caps as well. I know that there may be some more questions, Shikha, but Joe needs to go for the next meeting as well. So if you can take one final question before we wrap this up, please.
Sure. So, Supreet, the one last question that we can probably take is any threats from a supply side that we see to any of the tech companies now, including NVIDIA gets their supply from TSMC. So do you see that TSMC will be able to meet up with the demand, or are there any other alternatives that NVIDIA is looking at, and also, of course, the other tech companies?
Great question. I actually was on my Asian tour. I was actually just at the headquarters for TSM a few days ago, and I don't really think that the bottleneck is so much at TSM as much as the miscalculations in terms of planning and the demand, right? Like, in fact, last night or this morning, Jensen didn't talk about supply constraints or packaging constraints or CoWoS constraints at TSM. More than anything, it was more on the InfiniBand side where there was some bottlenecks from some of their partners that aren't TSM. And so I think it's more just on the planning side. Of course, if demand continues to sustain at these levels, and increases, we'll continue to be in supply, demand and balance. And I think that's a really good thing. I worry about when supply meets balance more than anything, because then we can get into an oversupply for some of these products. And that's, the cyclical nature of semiconductors. We will have that moment. The one thing that I'm very confident in around the industry itself, though, is that the industry of semiconductors is more attractive than it's ever been. It's consolidated into number one or number two players, and there's really rarely a number three in any market. And we've underinvested in areas like electrical engineering and semiconductor engineering and the hard, like the actual atoms of the world instead of the bits, right? Where we've overbuilt is in software development. That has been the easy money for the last 20 years. We've underinvested in the hard things. And that is very encouraging to me because that tells me that, yes, well, we'll still have these cycles from peak to peak and trough to trough. I think we continue to move higher. And that offers me a high conviction in that industry, whether it's semi and semi-cap for the next 3, 4, 5 years. At the same time, I'm also really excited about how this is all going to shape the services that we consume from a consumer perspective, how businesses really start to build AI and beat down inflation by enabling efficiencies, whether that's co-pilots or pilots. That will happen. I'm also really excited to understand and see how application software changes. And I think that's going to change dramatically. As we just saw, voice enablement is becoming maybe the next interface, right? Instead of having a screen and a keyboard, we may just be talking to our operating system. As that happens, applications have to change as well too. And there's a few companies that understand that today that are private, that are seeing a very strong investment cycle, but they will change the landscape, in years 3, 4, 5, and beyond. And so we have to keep a lot of humility and keep an eye on those opportunities as well.
Sure. So thank you, Joe. It was an absolute pleasure to have you here with us. And thanks, Supreet. And thank you all for joining in today.
Shikha, thank you so much. Yeah, it's a pleasure to be here. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.